Hey everybody, welcome back to another episode of the Better Wolf Podcast / show. This is the episode that you've been waiting for because I've gotten a ton of requests on asking questions about how you purchase cars. I personally own a Tesla, and I know some of you guys know that, and you're like, Caleb, I'm seeking that episode that you teased me a while ago about how to purchase a Tesla. To be honest, I'm just going to struggle with this piece of content because I'm always wary of people that are out there like saying, hey, listen to me because I have a nice car, I go on nice vacations, or I have a nice house. Just know that like we don't know the whole picture, and that same person that has that nice car could be renting it, could be having a terrible financial situation, or it could the opportunity cost of having that car is taking them away from actually making good investments. So just be careful when anyone, especially in Gen Z or a millennial is saying like, listen to me because of I have this X, Y, or Z. Just be very, very careful of that. Truth be told, I've had that Tesla for over 2 years. I rarely talk about it. And in fact, when I first got it, I thought my parents were going to disown me. And I just made it a point not even to mention it with my friends because I want them to know me and like me because of the character, because of the value, and not because of a thing that I own that, quite frankly, is depreciating. So a lot that we can get into. We can talk about depreciating assets versus appreciating. So I'm going to talk number one about the philosophy, the two parts that you need when you make any purchase. When you make any purchase, whether it's a car, whether it's a house, regardless, like these are the two things that you need to ask yourself. We're going to talk about that. I'm going to talk about how my mindset of going and purchasing a Tesla. And then the second are for the analytical freaks that want the numbers. And I have calculators here. I tried to combine this, but I just realized that like I just want to be as useful and I want to get this point across. And I know that some of you want to see the numbers and you need the context. I want to give you the context. But then some of you guys, all you need is the philosophy and you don't need to look at every single number. So when there comes to making any decision of like any major capital purchase, there are, by the way, a lot of people out there that are telling you to, you can get rich off of buying cars and all this stuff. Just be very, very careful. Don't buy in to fluff. Understand that every decision is really, really basic. And I'm just going to walk you through whenever you make a purchase, whenever you make a decision like buying a car, an airplane, a house, a vacation, whatever, there's like two basic things that you need. Number one is, should you buy that? Should you buy that car? Should you buy a Tesla? I mentioned airplane earlier because that's something that I'm looking to purchase in the future. Should you buy that? Should you buy that really is broken down in two things. Number one, do you have the money for it? Excluding the house decision, because I don't necessarily think you should wait till you have money to purchase the house. But when it comes to cars, when it comes to pretty much anything that you can purchase that depreciates over time, which goes down in value, if you don't have cash to purchase it outright, that is a red flag. And again, the situation always trumps the rule, but like if you don't have cash up front to purchase something, like be careful not to do it. I had plenty of cash to purchase Tesla, and I would not even think about it if I didn't have the money up front. Now, I didn't use cash to purchase Tesla. We're going to go into that being the second idea is how you purchase something, but I wouldn't make that decision if I didn't have it. Number two, a lot of people think if you have the money, you can buy it. Really, you have to create a savings plan and you got to pay yourself first. And if it prohibits your ability to pay yourself, and if it decreases your assets, just know that one decision is going to have a big time effect on your lifetime. I might have the money, but if buying that car would either eliminate my assets or take away from my ability to save, I wouldn't make that decision. I would really take a step back and saying like, is this wise for me to do? So those are like, can you afford things 101, just how I think about it. At the end of the day, really make sure, am I making this purchase? Now here's the problem that a lot of people get into is they mix the how you should buy a car and they mix the should you buy it and how should you buy it. And this is the same thing that like Dave Ramsey will say. He'll say like, don't buy a house if you can't pay for it in cash. Or he'll say like, don't buy a car if you can't pay it in cash. But then the assumption is that you're going to pay for that car in cash. And I'm hopefully going to make the point that even if you have the money, paying cash for a car is probably one of the dumbest things that you can do. And I'm just going to throw that out there because right now, at the time of this recording, interest rates are at an all-time low. And especially if you're an entrepreneur, especially if you have any investment desire in your body, you would be far greater off investing the difference, controlling the difference, growing the difference. I'm going to talk about my book, The And Asset. Even putting your money into an and asset would like out long term would even grow. Your assets would be far greater if you use a loan properly. Okay. So step number one, make that decision. Are you going to purchase that car? If the answer is yes, then the next question is how you make that decision. What's the most efficient way? how are you going to make that decision? I use this example a lot, but if you're going to travel from, Denver to, let's say, California, I could walk there, I could bike there, I could drive there, I could take an airplane. Eventually, all roads get me to California. An airplane would get me there the quickest. When we're talking about efficiency, we are simply addressing that same thing. Now, I don't think the efficiency is how to buy that car. It's ultimately the end goal in life. For most people, the end goal in life is not to be debt free, because that's ultimately you can be debt free and broke. The end goal is something, whether you call it retirement, whether you call it fulfillment. We talk at Better Wealth getting super clear on what results that you want and reverse engineering your time and your money to make those results reality. And so you want to be efficient with every decision you make so that you can get closer to that and that you can live that as soon as possible. And so there's really, when you're purchasing something, there's really two ways that you can purchase that. Way number one is pay cash. Now, pay cash sounds attractive, and essentially the pitch here is don't pay interest. Interest is evil. Loans are bad. Banks are evil. So what they say is, okay, my Tesla costs $65,000. You fill in the blank. Your car could cost $10,000. Could cost $100,000. Okay, if you took a loan for $65,000, you'd be paying, like, over 5-6 years, you'd be paying, let's say, $72,000 for that total. So that would pretty much say you're paying an additional $7,000 of interest for that decision. That's like, yikes. Like, why would you want to do that? That's bad. Paying interest is bad. But what we fail to do is remember, every decision that we have has a consequence. By paying cash, you don't pay interest, which is good, right? You're depleting your capital. You're losing that. In my example, 65,000. In some examples, at 10,000, 35,000, 100,000, and that money is no longer able to grow for you, work for you ever again. I want that to sink in, because what would your $65,000 be worth over 5 years if it could compound and you could control it? What would it be worth over 10 years? What would it be worth over 30 years? It's like, I want you to think about that. And then obviously I wrote a book called The And Asset, and we essentially talk about two functions, not just growth, but control. As an entrepreneur, as someone that, I believe capital, like, if you have capital, that is like the best position to be in, is access to capital. It gives you opportunities to invest, and it gives you opportunities to invest in yourself, into people, into opportunities. And so just by having that $65,000 on hand and thinking about that is like, I want to control that throughout my life, I can far out earn what I could earn over compound growth. And the And Asset shows you the ability to do that twice. You can essentially grow your money and collateralize it and use it. And even in the first 4 or 5 years, you might end up, quote unquote, paying a little bit more interest, but you've created a foundation. You've created a compounding machine. Compound interest takes money, time, and rate. So you're creating that, and hopefully you're putting it in a place that you can control that money throughout your life. So that is the philosophy of, like, the reason why you don't straight up pay cash for something is you understand that you can grow your money and you can control it, and that will outweigh the interest that you will pay. And remember, we're not just looking at a 5-year time period. We need to look at a lifetime period and think about our legacy in the future. So the way that I actually took this one step further, I actually, I said, like, you should never buy something if it depletes your assets or if it takes your ability to save more. So I save aggressively towards an And Asset, which this is a special overfunded life insurance. I know everyone says life insurance is terrible. If you set it up properly, it's an amazing place to grow your money and control it, because my money is growing long period of time, the rest of my life, tax advantage, no fees, no losses. It's like growing at around 3.5%, 4.5%. That's tax free. So it's an equivalent to 6 or 7% every single year. But the most important thing is it's giving me control to use that money, and not just use it and take the compounding growth out, but borrowing against it. And when I borrow against it, it allows my money to continue to grow. And then I get to decide whether I buy a car, whether I, invest in real estate or do whatever. Now, I have that set up, and I could use my And Asset for anything that I want. Now, I did not use my And Asset for the car because I could get a loan for that car. Now, I know this is like, okay, why would if I could bank by myself, why would I take a loan? Well, I understand that I want control and liquidity, and I could get the loan at a cheaper interest rate. So I literally do I feel like I was in debt? No, because I literally had option 2 using the And Asset. I could grow my money and borrow against it at the same time. My money's still growing. I could get a cheaper loan and continue to free up my money to do other things. This is where I feel like a lot of people that teach infinite banking or cash flow banking go astray, is because they're like, oh, you're going to get wealthy by using your own policy. That's not true. Anytime you borrow against your policy, number one, you're giving up liquidity of that event, and it's costing you interest. If you can go to a banking institution and get a cheaper loan rate and keep liquidity. And you could pay that off at any time. It just gives you more options. And options for me is key. So I know that this is sort of a rant, but let's just review. Number one, if you're going to make a purchase, make sure that purchase is the proper purchase and that you can afford that. Number two, how you pay for something matters. You can pay cash for that. You don't pay any interest. The problem is you lose that capital. You're no longer able to control it, and you no longer capture the growth of what that could earn. The second way that you could purchase that is by collateralizing your money. You invest your money and you get a bank loan or whatever, or you take the and asset, you save your money, you can borrow against that while your money continues to grow. That's way number two. That's a phenomenal way, especially if you can't get a bank to loan you money. You can, quote unquote, become your own banker and not get the benefits of cash without hurting you long-term growth. And then the third area is what I think the most sophisticated people do is they always shop the most efficient way to purchase something. My money is either invested. For me, my money is stored in overfunded and asset life insurance contract. I go get a loan for cheaper. The whole thing, my money's continuing to grow, and I have control and options to invest in my business or real estate or whatever. For me, that number three, option three, is the most efficient way to purchase that. What I'm going to do is I'm going to go over to my screen here, and you're going to see me in the corner. You're going to see some calculators, and you're going to see the three areas. And essentially, real quick, is anytime you make a purchase, you got to first of all decide, do I want to make the purchase? If that's the case, then obviously what's the most efficient way to do that? I'm making the assumption that you already have the money, because I would not recommend buying any depreciating asset. Depreciating asset is something that goes down in value. You don't at least have the money for that. The only thing is a mortgage or as a house, and it's common that houses go up in value, but that's not like hard and fast the law. It's just that's like the one exception that I would make. So all right, so pay cash for that car. In my case, that was a Tesla. So in that example, this was $65,000. Now, the benefits of paying cash is you don't have to work with the bank, you don't have to pay any interest, and you get it done quick. So you have the Tesla, you have no interest. A lot of people, including Dave Ramsey, would say, great job, you win, you're amazing at life. How I see it is I look at, you can see this in calculator above, I look at $65,000 and I ask the question, okay, what would be the bare minimum that I could earn over my lifetime? Now, being an entrepreneur, being an investor, being into money, I can earn a lot more than 5%. But if we're just baselining like, hey, over the next 30 years, I'm going to earn you 5%. I'm pretty confident in this, especially since I get a lot of opportunities. And just if you look at a low index of the market, this should be very attainable. It's again, asterisk, but you have to come up with this rate of return. Maybe you're less confident or more confident. That goes into this equation. Let's say you could earn 5%. That $65,000 that you paid for the car, you don't have to pay any interest, but that $65,000 is gone. You're never able to control it, and it's never able to grow for you ever, ever, ever again. And so the problem is over 30 years, that one car decision cost you over $280,000. It's $280,000. That car, and I just want that to land. You remember, you didn't just purchase that car, but you lost the $65,000 of what that could have earned you over your lifetime. Now, what's interesting, someone like me, I'm planning on living for another 60 years. That one car decision would have cost me $1.2 million, only assuming I could earn 5%. Now, I want to be very clear that I write in my book the importance of control. I believe control for me is far more important than even compound growth. And I talk about how you can actually maximize both compounding and control. But essentially, let's say over 30 years, just by controlling my money as an entrepreneur, I can make 9%. I'm talking to entrepreneurs that are earning 60, 70% on their money because they know how to use it, they know how to market, they know how to invest. But just 9% over 30 years, that's 862,000. Over 60 years, that's 11 million. Now, again, it's because consistency over a long period of time. Let's just go back to the 30 years. If you could just double the money that you're making, 10%, now you're talking about $1.1 million over your lifetime, over 30 years. And that's just an example of compounding. That's an example of control. So my big problem with paying cash is the plus, the plus is no interest. I'll write that in here. The minus, you're giving up control and you're giving up growth on that money. And for that reason, paying cash, I would pay a little bit of interest to have control and growth. And this is interesting because when you think about opportunity cost, you have to think about it in the function of long-term growth, short-term control. If you're an entrepreneur, if you're someone that's like an investor, control is going to be more important to you than compound growth. because you're investing in yourself. You're able to take a dollar and maybe double it. If you're someone that's working, that's high income earning, that's like working at a job and investing in a 401k or whatever, you have to make the determination as, do I actually believe that my money can grow? Is the market set up in a way that can grow my money? If the answer is yes, it's like, what would that look like? And that's how you need to make that decision. Number two is using leverage. This is essentially, invest the difference and then use a bank. And so let's talk about the problems of using the bank first. Is you take a $65,000 loan. Let's say you get approved. That's definitely a factor. And let's say over 60 months, I'm just using this calculator down here, the payment calculator. Let's just say you can get a 4% loan. Actually, let's do 5%. 5%, you have a payment of $1,221.54. If you go here to this calculator and put in $1,221.54, and you multiply it by 60, that represents the monthly payment over 5 years, you have $73,292. Essentially, the over 5 years of taking a loan from the bank, you are not only paying for the Tesla, $65,000, but you're paying $8,292 in addition. This is the interest. This is, I talk about in my book, the control cost of using someone else's money. Now, again, what people will say is that's a problem because that's extra money that you're paying. And for me, I go, okay, yes, but now my $65,000, I have control over it. What could I do with that? And I could grow it. Let's just assume for the moment that you could have 65,000 over, let's just say 5 years, over let's say 5%, same interest rate. That $65,000 would grow to 82. So just by compounding your money at 5% over 5 years, not touching it, not controlling it, the money is growing more than what you're even paying total over 5 years. Now, that's not a complete apples to apples scenario because you have a payment in this scenario, but it's like a lot of people when they look at that, they're like, oh, I would make the payment for 5 years or 60 months and that my money, like what I'm paying the bank and principal, is less than what I'm earning. And that's over just 5 years. Remember, you're creating a machine that's continuing to compound. So the compounding side or the growth, it's just like, number one, you can see like that's over 5 years. What about over 10 years? It's 105. Over 15, it's 135. Over 30, 280. The reason I think compounding is so amazing is just at these numbers, it's really, really powerful. And I'm using 5% because if you look at the and asset, which is a book that I wrote, which is it's using a special type of life insurance. I know a lot of people hate life insurance, and for the most part, life insurance is a terrible place to put your money. But if it's set up and used properly, it's overfunded, it's maximizing the cash. It's actually a phenomenal place to grow your money. And after everything, when you look at the internal growth rate, the actual growth rate of these policies, you're growing your money at 3.5 to 5%, and that's after taxes. Like that's after everything. And so it's like you would have to factor in taxes, fees, the cost of insurance, and a lot of times you have to earn a lot more than 5%. The reason why life insurance for me is so valuable is I get to control that money. So a lot of people would say like, oh, you can grow your money, but you can also have a guaranteed access to control it and buy whatever you want. This could be a car. This could be business and investment. So for me, the control aspect, it just depends. Everywhere where you put your money, if you put your money in a 401k, you have less control. If you put your money into an and asset, you have way more control. You put your money into just an index, you're off somewhere in between. Like you have more control, but if the market drops, you definitely have access to your money, but it could be putting you in an interesting situation. So leverage gives you, yes, the negative side is you have to pay interest, but that interest gives you the ability to grow your money and better control it. Now, what a lot of people will say, and this is kind of the beef that I have with our industry, especially the people that are teaching about how to become your own banker and all this stuff, is they'll say, oh, you can get wealthy by buying cars using life insurance. And I'm telling you, like, think about that logic. I could say like, oh, you can get wealthy by buying a Tesla. And here's why. And I could say that, okay, your money could grow in your life insurance, you could control it. And yes, you're paying $8,200 worth of interest, but your policy is actually making you a lot more. And I could see like, hey, over 10, 15, 20 years, your money's compounding at a greater rate than what you're earning. Well, that's misleading because I could also say, would I buy a depreciating asset? Why wouldn't I just buy an investment property or reinvest my money into an index or reinvest my money into myself? That activity would actually make me a lot more money because the Tesla or the car is a depreciating asset. So yes, this is a better way than cash. Yes, I could say over 10 years, I might have more money than what I paid, but that doesn't make me wealthy. That just makes it more efficient than paying cash. Again, it goes back to, I'm not telling you to buy anything. I'm saying if you're going to purchase that, make sure that you're being most efficient. Do not be confused. You will not be wealthy if you buy a car. You will not be wealthy if you buy a depreciating asset. Like, that's not going to make you wealthier. Again, if you're going to buy that, this could be a more efficient way to do that. But don't buy into the lie that it's like, this is going to make you wealthier by buying a depreciating asset. Like, I hear that all the time, and I just want people to start thinking, like, no, because if you do that and you use your and asset, you're giving up liquidity to say yes to X, Y, or Z. Think about that. All right, third way, this is actually the way that I recommend, and if you can pull it off and if it works, it can be a phenomenal way to do this, and it's essentially saying, okay, we obviously number 2 is a better way than number 1 in most cases. It's like you get more growth, you have more control. It doesn't make you wealthy, but it's more efficient to purchase that deal. But if you already have an and asset established and you have the ability to get a bank loan, a lot of people are saying, hey, don't have any bank loans, just bank on yourself. Again, does not make a ton of sense. And I'm just being real with you guys. Like, that doesn't make a ton of sense, because why would you want to give up liquidity? It's like, this is not a magical thing. Like, this is, if you use an and asset and you use it to buy a Tesla or you use it to buy anything, now you're giving up liquidity. And yes, your money's continuing to grow. Yes, it's more efficient than paying cash. But if another opportunity comes, you're only able to invest. And I recommend everyone having an emergency account. So it's like you're kind of strapped for how much you can tap in. What I would recommend is if you could get a bank to give you a loan for maybe even cheaper, keep liquidity, keep control of your and asset, it's still going to grow. And now you have access to capital that you can utilize as well. So the way that I actually did this, and it's just a way to think about it, is I put money into an and asset, and my money grows and I can control my money. And when I have an opportunity, like an investment opportunity or business or whatever, and I can't get a bank loan, obviously this is access to capital and I want to be able to use it. Because of the car, and it's very common to get car loan, I got a Tesla loan quote for I think it was like 3.7% interest. So right now I got cheaper money. Let's just do that. $65,000 at 3.7% over 60 months. It's 1,184. Let's actually do that. $1,184 and 64 cents multiplied by 60, 71,000. So I paid over 5 years, and I'm not 5 years into this, but 71,080 bucks. So I paid an additional 6,780 over 5 years of interest. Okay. And my money is in my and asset. It's continuing to grow. It would have grown regardless, but I'm able to control that money and say yes to opportunities that are going to earn way more than 3.7%, way more than 3.7%. We're talking like in the process of doubling my business, in the process of, saying yes to other investments. And so I wanted to keep more control in the scenario. So again, I'm looking on the screen. I know there's chicken scratch. Hopefully you followed along, but number 1, paying cash. Paying cash it's convenient. The problem is, number 1, your money to pay cash, it's obviously sitting somewhere that's probably not earning you a ton of interest. And then you give up control and growth. Using your policy as leverage, essentially you're putting your money in a place and then you're borrowing against it. This could be, an and asset where you put your money in, it grows the rest of your life, you can borrow against it. And a lot of people use that to buy cars. That's great, that's fine. But I've just found that if you can use the and asset and combine that with a bank, and usually that gives you more growth, more control, and just so you know, the policy doesn't grow anymore, but it gives you the ability to control your money so that you can grow it more. Instead of buying a depreciating asset, you can buy something else. I just want to clarify that. Your policy will be the same regardless whether you borrow against it or not, if it's with the right company. There's the example. Hopefully that made sense. I'm continuing to get better with these videos. And I just want people to start thinking as it relates to every decision you make has a consequence. And again, I feel like a broken record here, but we want people to understand that money is a tool. Loans can be a tool. Anything, any financial instrument can be a tool to better live your life. And if you don't have clarity on what that looks like, that's more important than figuring out the best way to buy a car, because maybe you shouldn't even buy a car because buying that car might not get you closer to where you want to go. So you can find out more at betterwealth.com. You can get my book. You can listen to more episodes on YouTube or on the podcast. I'm continuing to make content because I know that this kind of stuff will help people think differently. We're all about thinking differently at Better Wealth. Take care.